in Silicon Valley boardrooms and trading desks from Tokyo to New York. A quiet unease is spreading. The artificial intelligence revolution is in full swing. Billions are flowing into data centers, advanced chips are rolling off production lines at breakneck speed, and corporate balance sheets are being stretched to fund what many call the next technological frontier. But beneath the surface of this historic tech expansion, a growing number of analysts, investors, and even insiders are asking the same haunting question. Is this real, or are we building a house of cards on promises yet to be fulfilled? Right now, we are witnessing the most aggressive infrastructure build-out the tech industry has seen in decades. Companies aren't just dabbling in AI, they're betting their futures on it. Cloud providers are constructing multi-billion-dollar data centers at record pace. Tech giants are signing supply contracts for tens of thousands of NVIDIA's H100 and soon to launch B100 GPUs. The demand for computing power is surging, and no company sits at the center of that storm more than NVIDIA. It has become the undisputed linchpin of the AI era, supplying the specialized graphics processing units that train the largest language models and power the most advanced AI applications. In that sense, NVIDIA is the shovel seller in what feels like a modern-day gold rush except. Now, there's growing evidence that the shovels might cost more than the gold itself. And here's the twist. NVIDIA isn't just selling shovels. It's also investing in the prospectors. Through strategic venture arms and direct equity stakes, NVIDIA is channeling profits back into AI startups and emerging platforms that, by design, depend on its hardware to function. That creates a feedback loop, a circular flow of capital where investor money pours into AI firms, which then spend heavily on NVIDIA chips, boosting NVIDIA's revenue and profits, which in turn get recycled into more AI investments, often in the very same companies. The mechanics are elegant on paper, but they raise a critical concern. Is the growth we're seeing being driven by genuine market demand, or is it artificially sustained by an ecosystem that rewards participation more than profitability? That's not a trivial question, because if you look at the scale of investment pouring into AI over the next several years, the numbers are staggering. Estimates suggest that global spending on AI infrastructure could exceed $1 trillion by the end of the decade. Some analysts have run the math and concluded that for this investment to be justified, the AI economy would need to generate roughly $2 trillion in new revenue by 2030. That's not incremental growth. It's the equivalent of creating an entirely new Silicon Valley, 10 times over, in less than 6 years. And here's why that matters. No one has a clear roadmap to how that revenue will materialize. Will it come from smarter advertising, from enterprise automation replacing millions of knowledge workers, from consumer AI agents selling subscriptions? The answers are still speculative. The investments, meanwhile, are all too real. Nowhere is this tension more visible than in Asia, where the continent's industrial and financial giants are playing multifaceted roles in the AI ecosystem. Take SoftBank. The Japanese conglomerate, led by its visionary and often controversial founder Masayoshi Son, has long positioned itself as a catalyst for tech disruption. Its vision fund became synonymous with high-risk, high-reward bets on startups like WeWork and ByteDance. But in a move that sent ripples across global markets, SoftBank sold its entire remaining stake in Alibaba in November for $5. $8 billion funds it now intends to redeploy aggressively into AI ventures. On one level, this is strategic reallocation, shifting capital from a proven e-commerce giant to what Sun sees as the next frontier. But it's also a symbol of the market's growing appetite for risk. Selling a cash-generating, globally dominant internet company to fund AI moonshots that may not turn a profit for a decade. That's not hedging, that's doubling down on the future, whether the present can bear the weight or not. Meanwhile, other Asian tech firms are showing signs of more grounded performance. Samsung and SK Hynix, both based in South Korea, dominate global production of high-bandwidth memory, or HBM specialized memory chips, that serve as the high-speed data highways inside NVIDIA's AI processors. Without HBM, modern AI models can't be trained efficiently. And with demand exploding, these companies have seen their profit margins expand dramatically. In the last fiscal year, SK Hynix reported a more than 300% increase in operating profit, directly tied to AI-driven demand. Samsung's semiconductor division, after a bruising downturn in 2022 and 2023, is now experiencing a strong rebound, thanks entirely to AI-related chip orders. This isn't speculative growth, it's measurable, it's real. And it underscores a key divergence between the US and Asian tech markets. In the United States, much of the AI enthusiasm has been reflected in sky, high valuations, soaring stock prices, and relentless investor optimism, even for companies with minimal revenue or clear paths to profitability. Narrative is king. If you're in AI, you're in the future. But across Asia, many of the key players are tied to physical outputs, chips, memory, manufacturing capacity, whose performance can be tracked in quarterly earnings reports, production volumes, and global supply chains. That's why analysts increasingly see Asian tech as more insulated from a potential correction. When the market eventually stops believing in blue sky valuations, companies that actually produce something tangible may prove far more resilient. Nowhere is this contrast more revealing than at TSMC, the Taiwan-based semiconductor foundry that manufactures the majority of the world's most advanced chips. If NVIDIA is the engine of the AI revolution, TSMC is the factory that builds it. It produces the processors for NVIDIA, AMD, Apple, and countless other hardware innovators. Because it sits at the very top of the semiconductor food chain, its monthly revenue reports are treated like economic indicators for the entire tech sector. When SEP grows, the world believes demand is strong. When it slows, alarm bells go off. And in October of this year, TSMC reported its weakest monthly year-over-year revenue growth in over 15 months. Not a collapse. Growth was still positive, but noticeably decelerating at a time when AI investment is supposedly accelerating. That data point did not go unnoticed. It sparked a wave of reevaluation among investors. Some began to wonder, are real customer orders failing to keep pace with the hype? Is the AI infrastructure build-out running ahead of actual AI deployment? Because the truth is, building a data center is one thing. Filling it with AI workloads that generate meaningful revenue is another. This brings us to the heart of the matter. The debate over AI isn't really about technology. It's about economics. It's about whether this current cycle is laying the foundation for a new era of productivity and profit, or whether we're reliving the script of 1999, when investors poured trillions into dot-com companies with no business models, driven by little more than the belief that the internet changes everything. The parallels are hard to ignore. Back then, it was fiber optic cables and portal websites. Today, it's data centers and generative AI. Both were transformative technologies. Both were overhyped. Only one eventually delivered lasting value. The risk today is that we're conflating technological possibility with financial inevitability. And yet, to dismiss AI's potential outright would be a mistake. Unlike the dot-com bubble, where many companies were little more than concepts, today's AI leaders are demonstrating real functional progress. We're seeing language models that can write code, diagnose medical conditions, and draft legal documents. We're seeing AI agents that can plan travel, negotiate prices, and summarize dense research. Enterprise adoption is accelerating across finance, logistics, and customer service. This is not vaporware. This is not hype. This is actual technology being integrated into real-world workflows. The substance is under the hype. The question is not whether AI will create value, but when, how much, and for whom. For investors, that ambiguity creates a difficult calculus. Do you allocate capital now at what may be peak optimism, knowing that even a transformative technology can be overvalued in the short term? Or do you wait for a pullback, risking the chance of missing the foundational phase of a new economic era? There's no easy answer. But what is clear is that the current environment rewards deep analysis over blind momentum. It rewards scrutiny of not just what a company claims to be doing with AI, but whether it's generating cash from it. It rewards attention to fundamentals, margins, utilization rates, customer contracts, and, above all, real demand. The Asian tech sector, with its emphasis on manufacturing, supply chain control, and steady earnings, may be better positioned to weather uncertainty. In contrast, U.S. tech firms, especially startups and smaller AI pure plays, face a harsher reckoning when capital markets inevitably tighten and investors demand more than PowerPoint slides and product demos. So where does this leave us in a moment of profound transition? The AI revolution is real. The infrastructure being built will serve as the backbone of the global digital economy for years to come. But the financial markets, always one step ahead, may have gotten too far ahead of themselves. The circular funding models, the speculative investments, the decoupling of stock performance from revenue growth, all of these suggest that while the foundation of AI may be solid, the market's expectations around it are built on shifting sand. The coming months will be a test of patience, a test of realism, a test of whether the trillions being spent today can generate returns that justify the frenzy. For now, the machines are being built, the chips are being produced, the models are being trained. But in boardrooms and trading floors, the most pressing question remains. When the gold doesn't materialize, who's left holding the shovel?